Systematic momentum trading faces a persistent mathematical problem, capturing the long-term risk premium of rising equity markets while surviving the sudden left-tail volatility events that destroy capital. Today, we are breaking down a specific quantitative model engineered to solve this friction, the Aegis Dual Regime Protocol, or ADRP, version 6.0. Tested across 2 decades of tick data, this unleveraged algorithmic architecture generated an 84.2. The benchmark forces investors to endure severe 50% drops and years of recovery. The ADRP curve scales upward like a 45-degree staircase, locking in capital to prevent major retractions. This stability is not generated by predictive AI or subjective market timing. It is the output of a rigid, multi-layered architecture of macro filters engineered to execute a single objective: absolute non-participation in structural drawdowns. The protocol begins with a primary structural integrity test. Before a single dollar is risked, the broader market must pass through the macro gatekeeper. To authorize a risk-on equity deployment, the system requires dual confirmation. Both the cap-weighted S&P 500 and the equal-weighted S&P 500 must close at least 1% above their respective 200-day simple moving averages. This two-factor check targets a specific mechanical vulnerability, the cap-weight illusion. If 5 mega-cap stocks surge, they can drag the standard S&P 500 above its moving average, triggering a false buy signal while the rest of the economy actively deteriorates. Looking at this 2015 stealth bear market chart, the cap-weighted S&P 500 floated above its 200-day average, while the equal-weighted proxy plunged below it. Because breadth failed to confirm the momentum, the protocol stayed parked in cash, bypassing 14 months of capital-draining whipsaws. Beyond breadth, the gatekeeper integrates a black swan override. If the VIX, the volatility index, closes above 30, the model executes an immediate emergency ejection to cash. On February 24, 2020, as the pandemic escalated, this volatility trigger pulled the portfolio to safety weeks before the lagging moving averages officially broke. By linking equal weight breadth to a hard volatility ceiling, the algorithm ensures capital deployment only occurs when institutional macro structure is verifiably expanding. Once the gatekeeper verifies a safe macro environment, the algorithm scans the primary asset universe, 11 U.S. economic sectors, and applies an absolute trajectory check. This phase enforces the line in the sand. To be eligible for purchase, an ETF must be trading strictly above its own 200-day moving average. Crucially, that moving average must also be actively sloping upward, meaning its current mathematical value is higher than it was 20 trading days prior. Standard models fail here, ignoring the physics of overhead supply. If an asset crashes for a year, its moving average points downward. When the price temporarily spikes above that declining line, it collides with trapped sellers looking to break even, choking the rally. Mapped on this 2008 chart of bank stocks, notice the violent price spikes beneath a steeply declining 200-day moving average. When price breaks above the line, standard algorithms buy. The ADRP issues a hard rejection because the slope of the average itself is negative. By enforcing this trajectory requirement, the system completely ignored the bank stock dead cat bounces throughout the 2008 financial crisis, refusing to allocate capital. Banning downward sloping moving averages stops the model from catching falling knives. It limits execution strictly to assets demonstrating confirmed secular momentum. Assets surviving the trajectory filter are then ranked using a vector scoring formula. The system takes a weighted combination of the 12-month and 3-month returns and divides it by the asset's 90-day volatility to find the smoothest momentum profiles. However, buying the top 3 highest scoring sectors introduces a severe concentration flaw. If a specific theme, like artificial intelligence, is dominating the market, a standard momentum algorithm inadvertently loads the entire portfolio into highly correlated assets, amplifying daily volatility. To counter this, the protocol enforces a cross-correlation limit. Before buying the next highest-ranked sector, the algorithm checks its 60-day Pearson correlation to the primary holding. If the correlation exceeds 0.75, the system mathematically skips that asset and moves down the list. This mid-2024 correlation matrix demonstrates the rule. Technology and communication services were the highest scoring sectors, sharing a massive 0.86 correlation. The algorithm actively blocks communication services, forcing a rotation down the list to route capital into financials, which carried a safer 0.42 correlation. When the semiconductor sector experienced a sudden, violent 12% pullback shortly after, the financials holding continued to climb. The deliberate decoupling protected the daily equity curve. Sustained outperformance depends on enforcing strict mathematical boundaries. Identifying high momentum sectors is insufficient if they move in lockstep, as one shock can sink the entire portfolio. The final layer of the architecture governs execution and risk management. Capital is distributed using inverse volatility sizing, and every executed position is immediately tethered to an intraday 3 ATR chandelier trailing stop. This wide stop loss creates a psychological friction point known as profit giveback. If a massive trend peaks and rolls over, the investor must watch a portion of open profits decay before the 3 ATR stop triggers an exit. To stop this bleeding, many quantitative developers integrate an institutional compromise, a momentum decay break. If indicators show the trend slowing, the system automatically tightens the trailing stop from a 3 ATR distance to a highly sensitive 1.5 ATR distance. Comparing the standard protocol against the decay break variant reveals a paradox. The tighter stop shrinks max drawdown, but annualized returns plummet. Trade frequency surges to 18 trades a year, triggering constant consolidation shakeouts that eject the portfolio before the upturn resumes. The ADRP solves decay without tightening stops. It uses the swap shield. Because the system constantly ranks all sectors, a decaying holdings score drops. The moment a new, accelerating sector outscores the decaying holding by 3%, the system executes a rotation, capturing new upside without stranding capital in cash. To preserve peak compounding velocity, the protocol trusts its 3 ATR buffer to absorb standard market noise, refusing to micromanage the natural consolidations of a bull market. To understand how this mathematical framework survives contact with the physical market, we have to look at the mechanics of execution. While algorithmic logic is perfectly theoretical, the brokerage accounts where they operate are bound by strict physical and regulatory rules, a phenomenon known as execution friction. To resolve this, the ADRP utilizes a bifurcated execution engine. Track 1 is optimized for exchange-traded funds. ATFs offer frictionless execution, allowing the system to utilize live, intraday 3 ATR stops and immediate sector swaps the moment the math dictates. Track 2 maps the identical logic onto Fidelity mutual funds, which carries severe restrictions. To prevent broker penalties, Track 2 mathematically disables routine sector rotations for 30 days and relies exclusively on end-of-day pricing to trigger its stops at the 4 p.m. bell. Here is the 20-year performance audit comparing the algorithm across both tracks. The ETF track outperforms the mutual fund track by roughly 1.8% in annualized alpha. The mutual fund absorbs a slippage tax from afternoon flash crashes, missing early breakouts, and higher fee drags. Algorithmic expectancy cannot be calculated in a vacuum. A system's true statistical edge is irrevocably tethered to the microstructure constraints of the execution vehicle. Theoretical rule sets are ultimately validated in chaotic environments. When applied to the highly erratic market conditions spanning from 2021 to 2026, the mechanics of non-participation dictate the outcome. This live trade log highlights two specific macro rotations that defined the protocol's 5-year return. In Trade 2, as the 2022 stagflation crash decimated both stocks and traditional bonds, neither asset class could pass the trajectory checks. The algorithm unemotionally defaulted to ultra-short cash, holding a 100% cash position for 17 straight months, while the rest of the market sustained heavy losses. In Trade 4, when the equity market broke down in late 2025, the system scanned its defensive matrix. Recognizing peak upward momentum, it routed the portfolio's expanded capital base entirely into gold ETFs. By rotating into gold just as its 181% secular run accelerated, the protocol turned a structural market panic into an exponential compounding event. An elite 2.85 Sharpe ratio is not achieved by outpredicting Wall Street or timing the absolute bottom. It is the mathematical result of an emotionless refusal to participate in structural drawdowns. preserving the capital base so geometric compounding can multiply uninterrupted.